This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China rallies, Beijing signals fresh support for a struggling economy, including further easing of policy curbs in the property sector. Investors gear up for earnings from some of the world's biggest corporations. So far, it's been a mixed bag of results in Europe, and later today, big tech takes the spotlight with Microsoft and Alphabet reporting. And Russia attacks a port on the Danube River in Ukraine, intensifying efforts to cripple a vital route for Ukrainian grain to reach world markets. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, the busiest week of the summer rolls on. There's some more European data, and then the big earnings to come, LVMH and all the big cap tech.
Yeah, and it feels like maybe China was feeling a little left out when it comes to all the action, so they decided to hop on board as well. And I think that's what's really moving the markets this morning, Dani, especially when you talk about risk sentiment really coming from Asia all the way stateside. Take a look at what futures are doing, higher by 0.2%. Again, no major conviction to the upside, but you are still seeing green on the screen, and that is a big deal given all of the potential volatility you're going to see this week with the earnings story, with the central bank story, and of course, any other breaking headlines we get in perhaps next hour or the rest of the week. So that's going to be something to keep an eye on. 45.91 is what we're seeing on S&P futures right now for our radio audience. The bond market, though, is really where the volatility kicks in. Take a look at the two-year yield. The front end of the curve already seeing a move about 5 basis points lower. That is not the case as you move further out. That's actually where you start to see the yield increasing by, we'll call it 2 basis points, 3.88 on the 10-year yield. Remember, what does the Federal Reserve say tomorrow about the hiking kind of pattern that they have? Is that pause from the last meeting going to be their last pause, or are they going to take the Goldman route, for example, which is pause, hike, and then perhaps set the tone for other central banks around the world? That's the question I have, and we're going to explore throughout the rest of the hour. Of course, Brent crude trading at about $82 a barrel, but I want to go back to the overnight session that we saw because, again, China is moving the markets and certainly moved the markets overnight. If you look at the Hang Seng Index, for example, you saw an over 4% rally overnight, plus some strength in the Chinese yuan as well, even copper getting on board on that rally. Basically, the idea here being that China is increasing a lot of their policies, their stimulative policies when it comes to the property sector. We're going to dive into that in a moment, Dani, but for now, that seems to be what's moving most markets.
It is this sensitivity to the inflation concern, Kriti, that I find really fascinating. Inflation does appear to be coming down, according to latest CPI reports, but that picture in China plus in oil's 2% rally yesterday means that 10-year break-evens in the U.S., they've climbed the most in the past 5 days since October of last year when we had a really hot CPI reading. We're treating this market as if any pickup in the China narrative or commodity narrative will mean a re-inflationary environment. Now, when it comes to that China narrative, it's having its impact on European stocks. Listen, if it wasn't for the China excitement, I'm sure European stocks would be down because most sectors are lower, except for basic resources. Basic resources are up nearly 4% today, again, because of that copper rally you just showed, because of what commodities are doing. Now, if you're watching on TV versus listening on radio, you will see that the euro versus the dollar in front of me keeps flipping back and forth from the dreaded unched to a little bit lower. Volatility here after some really stunning data, Kriti. We had the ECB's Euro area lending survey. Lending, property lending, car, auto lending, all of them dropped. But for the private sector, for corporations, it dropped by the most on record. In fact, demand for loans was worse than 2008. If there's any question as to whether or not the ECB is in restrictive territory, there is your answer. It absolutely is, especially combined with the PMIs. It did momentarily send two-year yields lower in Europe. German two-year yields, though, are now higher by about 2.5 basis points, Kriti.
So already seeing some cross currents in the European session as well. Let's get back to the China story, Dani. As you mentioned, that seems to be overshadowing the rest. A booming rally this morning with property stocks extending gains to the most this year. Joining us now is Bloomberg Markets reporter Justina Lee. Justina, we've been seeing this kind of behavior come out of China for a while now. Any sign of kind of weakness in the Chinese economy is met with a wave of support. How is this time different?
Yeah, it's pretty funny because all the signals we're getting out of the Politburo meeting, I mean, essentially, they're not actually that explicit. They're pretty vague, but we've already had kind of like a flurry of notes from economists helping us decode that. And what people are expecting out of this meeting is, more policy rate cuts, more cuts to the reserve requirement ratio, and some easing of property policy. That one they were pretty explicit about, and also some special issuance of these infrastructure bonds. So all in all, what economists out of Wall Street have been saying is that this has been a little bit more dovish than they were expecting. But of course, that's also because they've probably lowered that bar because they've been disappointed a few times this year already.
Yeah, I was going to say, we're just showing the property index there, the biggest move of this year, 10%. They get rid of that phrase, housing is not for speculation. You mentioned a little bit of Wall Street's expectations, but still any rally in China, it feels like is difficult to maintain itself. So do expectations this time, does it seem like we're going to continue to get that rally?
Yeah, I think people are a little bit more hopeful this time because we did get more decisive easing signals out of Chinese policymakers. But I think the recognition here is that the challenges China is facing at the moment are a bit more complicated than what just a few kind of policy changes can handle. I mean, we're talking about, an aging demographic, kind of like a structural oversupply in property, and of course, icy relations with the U.S. And so I think kind of putting all these together is the reason why, even though we've kind of had that initial reopening rally out of China, that's been pretty hard to sustain.
Certainly something we're going to be keeping a close eye on, especially as it's already dominating the market narrative around the world. Justina Lee, all over that story. We thank you as always. And we go from Beijing to Brussels. EU's agricultural ministers meet today. Top of the agenda, the Ukrainian grain exports that comes after Russia escalated its attacks on Ukrainian ports to one on the Danube. Joining us now is Mark Champion, Bloomberg Senior Reporter for International Affairs. Mark, put this into some context for us. Just how big of a deal are these ports?
Yeah, it's actually really interesting because these were small ports. Before the war, they were quite unimportant. But during the Soviet period, the port of Reni, which got hit, that used to put about 11 million tons a year through in terms of cargo. So it was important back then. Before the war, it had declined to about 200,000 tons of cargo a year, and it was climbing back up towards the 11 million. As a result of the closure of the Black Sea ports, as the Ukrainians really tried to get their 3 ports on the Danube to compensate. And so they had plans, which they announced just last month, that they want to get the throughput in those ports up to 30 million. So what the Russians have really done is to try and send a signal that you're just not going to be able to do it. These were ports that were really designed to get around the grain deal, rather the grain blockade. And now that the Russians have pulled out of the deal, they're trying to close that loophole.
Yeah, I must say the market action is weird. We had wheat spike to a 5-month high. It seems to be coming in now. Mark, we do have EU agricultural ministers meeting today in Brussels. What can they do at this point?
Yeah, it's quite limited. I mean, they have been trying to encourage these routes and to bring as much grain as possible through the ports and then out to the Black Sea via Constanța in Romania. They've also been trying to get it into Poland by rail. The problem is that the logistics within Eastern Europe, they're just quite constrained. They have their own grain industries. During the harvest seasons, the export seasons, they get congested. So what happens is that the Ukrainian grain gets stuck in these countries and it gets sold, and it suppresses prices. These countries are some of the Ukraine's strongest supporters in terms of the war, but when it comes to grain, they're not, and they're the ones who are standing in the way of EU efforts to get more grain through.
Mark, thank you very much for that. That is Bloomberg's Mark Champion. Now, earnings season is in full swing with Unilever sales beating estimates. The company raised prices even as they cited an inflationary environment that was starting to ease. A lot of corporates to get through here in Europe. Joining us now to do just that is Dasha Afanasieva. So we have Heinz Schumacher, Dasha, finally at the helm of Unilever for the first earnings results. Do you think he'll be pleased with these results?
Yeah, he's just a few weeks in, and I think he'll be pleased in the sense that they're not terrible and they've beat expectations. But of course, as an incoming CEO, you kind of want to set the bar low and then show everybody how far you've come. But I think beating results is good for him. And he'll also, he's going to be updating the market properly on what he thinks needs to happen at Unilever in a few months. But today he said some positive things. For example, that the organizational structure that his predecessor brought in last year is working, and it's creating a better, more proactive environment.
Well, Dasha, speaking of keeping the bar low, talk to us about Adidas here. Is the worst over for the shoemaker?
So Adidas said that it's actually increasing its outlook because it it's said that it's going to be able to sell the Yeezy shoes. But I think the key thing to remember here is it's still going for a loss of 450 million euros. That's down from 700, but it's still not great. And actually, new chief executive Bjorn Gulden, who came over from Puma, is known as someone who would be setting the bar low, making things look bad and then surprising on the upside. But I think the key issue for him remains, which is how do you make Adidas outside of Yeezy? How do you make it relevant? How do you reinvent it? How do you finally make it compete with Nike, after decades of trying to?
And it does really feel like there's been a lot of C-suite shakeups in Europe. It does seem that way between these two, doesn't it, Dasha?
Absolutely.
Yeah.
I mean, amongst the consumer goods sector, definitely.
Yeah, well, it definitely is a difficult time. So you understand perhaps why they're doing that. Dasha, thank you so much for joining. Always great to get your insight. That's Bloomberg's Dasha Afanasieva. Now, coming up, a rare Wall Street mea culpa. Morgan Stanley's Mike Wilson says he stuck with his bearish view for just too long amid a stock rebound. Klonovich maybe on the different side of things. We're going to discuss that. Plus, we're going to catch up with Michael Reinking, NYSE Senior Market Strategist, later this hour on what he calls the most important week for markets this summer. I think few would disagree with that sentiment. All of that coming up. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London with Kriti Gupta in New York. Kriti, we had some data come out about an hour's time ago. It was twofold. One, Germany IFO survey comes in, weaker than expected. It might be IFO. I'm going to be honest. I always misremember that. The other one, which I think is even more interesting, is this ECB survey of lenders. Corporate loan demand, Kriti, has dropped the most on record. Not only has it dropped the most on record, but demand for loans, it's lower than 2008. That initially sent the euro lower. It sent yields lower, too. But I think if there's any question as to whether the ECB is in restrictive territory, this is it. They are clearly crimping the economy.
I think the divergence is so key here because when you look at loan growth stateside, you are not seeing the same results, despite the expectation being that that's exactly what was going to happen post-banking crisis, post-economic slowdown. Yes. And you're seeing the exact opposite. You're actually seeing actual loan growth here in the States. So to see a pullback in Europe is really interesting, given that the Fed and the ECB, in theory, are on the same page.
Well, that's why I asked this question to Point72's chief economist yesterday, Dean Mackey, that I felt like was a little bit controversial. But, I mean, he didn't even seem to think it was, this idea of could we get an ECB that cuts before the Fed? That's not what's priced in right now. We have the Fed. The assumption is that they'll cut at some point next year. That's not priced into the ECB assumption. But if indeed the European economy is worse off, we saw that with the PMIs yesterday, this survey demand is really weak. Perhaps it's the ECB that capitulates first, Kriti.
I mean, and they very easily could, because when you look at kind of the moves, and I'm going to use a little wonky language here, a little standard deviation talk, Dani, when you talk about the volatility in terms of the economic data in the European economy, you can see the drop comes way more aggressively, for lack of a better term, than you see in the United States. And essentially the idea here is a recession doesn't necessarily happen gradually. It happens all at once. And I think in Europe, when you see that dynamic, it's kind of almost magnified.
Kriti, I feel like you do this thing where you say you're about to say something wonky, and then you say something beautiful and eloquent and easy to understand. And nerdy. It wouldn't be
I kind of learned it from you, honestly. So here we are.
Oh my gosh, my heart melts. My heart melts. All right, Kriti, we'll take a pause in this love fest. We'll continue it, I'm sure. Let's talk more about European banking, because UBS will pay a total of about $387 million in fines related to misconduct by Credit Suisse in its dealings with Archegos as its new owner starts picking up its legal tab. Let's bring in Bloomberg's Tom Metcalf on it. Look, these numbers, the market seems to have welcomed it. It's finds from kind of every single region here. What should we make of it?
Yeah, I think it was pretty well flagged. So about a month ago, this kind of delta was sort of was sort of laid out. So I think most people are saying, well, at least it's been resolved. Obviously, UBS's big push is to try and get as much of this litigation done, put behind them. And for me, the interesting thing is, have UBS almost sort of accelerated this process? Because, of course, there are other banks involved in Archegos, right? You have Nomura, you have plenty of others, and it's wondering, are fines coming down the pipe for them, or is this sort of a Credit Suisse-specific instance?
Tom, talk to us a little bit about the Citadel story here as well, because in addition to kind of the loan growth dynamics that we're seeing and the fines that we're seeing, we're also seeing trading volume take a little bit of a hit. Explain to us why we're seeing that in Citadel.
Yeah, that's probably the most interesting thing of this set of results. So the last few years, last few quarters, you've seen revenue at Citadel Securities, so this is sort of the market maker of Ken Griffin's firm, just go through the roof, and now they're dropping back like 35%. And really, it comes down to much more reduced volatility this year. So the markets don't seem any less exciting to me, but I think for the trading side of things, it's been a much calmer, and with fewer volume, that's where they really get hit. So really pointing towards that sort of structural change in the last, I guess, 6 months.
Now, in terms of phrases that can send shiver into the spines of global traders right now, it feels like uninsured deposits is one of them. Post-SVB, the FDIC here warning banks over errors in reporting in it. How critical is this? What exactly is the FDIC hitting out at banks about?
Yeah, I think this was sort of one of those metrics that perhaps was not so closely scrutinized, obviously, before sort of the regional banking crisis. Now it is, and it turns out that quite a few of the data points being shared by those banks were off, whether too high, too low. So I think it's, dozens of US banks have effectively had to revise the data they've been supplying. I don't think there's any implication in terms of sort of regulatory fines or anything like that. It's much more like, wait, this is probably one of the things that investors, at least for certain banks, are looking at most closely. So it's pretty fascinating that you've had across the board a lot of changes. So banks like Bank of America, not just the smaller regional banks, making some adjustments.
And do we expect some of those kind of adjustments that we saw by a bigger margin of Bank of America to follow? Do we see some of that in, say, the likes of JP Morgan, Goldman, especially JP Morgan, as they kind of absorb the First Republic loan book?
Yeah, my sense so far is these changes or these revisions have sort of now kind of caught everyone up. So Bank of America, for example, saying, we're not expecting to make any more adjustments to this metric. And you'd think if, a bank wasn't named in this report or this statement, it's unlikely to need to make further requirements. But you're right, some banks are absorbing other banks, right? And they will then need to check that. I suspect, though, this is probably kind of boxing this off.
Tom, thank you very much. All the banks, you've got it covered. Tom Metcalf there from our Bloomberg Finance team. Coming up, Wall Street's biggest bull and bear. One of them capitulates, one stays with the sell-off story. We're going to have more on the very interesting calls from Morgan Stanley's Mike Wilson and JP Morgan's Marko Kolanovic next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Now, here's something that caught our eye, and let's be honest, it caught all of your eyes. It's one of the most well-read stories over the past 24 hours. Stock bear Mike Wilson of Morgan Stanley has offered a mea culpa on his call, saying he stuck with the pessimism for too long. He writes in a note, quote, "We were wrong. 2023 has been a story of higher valuations than we expected amid falling inflation and cost cutting. Still, his forecast for the S&P 500 remains at 3,900, while the benchmark is close to erasing last year's decline. His team's target for June 2024 is at 4,200. Now, he was also once one of Wall Street's biggest bulls. He's been more bearish as of late. He, on the other hand, has decided to stick to the bearish call. JP Morgan's Marko Kolanovic warns that the delayed impact of global rate hikes and the geopolitical backdrop could spur fresh market declines. Kriti, he goes on to say that there will be a market sell-off. He's just not sure when it happens. And look, I'm going to be honest here. Is not saying there's going to be a sell-off at some point also being like it's going to rain at some point? Like, of course, at some point, the market will sell off.
Yeah, I mean, you got to have the right call. We got to have to time it right as well. And it feels like the timing is the unclear part. We'll have to wait and see what he says. But I think what's interesting is his reasoning here. He's saying the delayed impact of this kind of rate cycle I think it's interesting given that in the last 24 hours, we also heard from David Kostin over at Goldman Sachs. He actually turning bullish, getting in the Mike Wilson camp as well, but also saying that his reasoning came more down to the rates. No one really is talking about the fundamentals here, Dani, or the idea of breadth. They're saying this is really a cross-asset story. It's coming down to the Federal Reserve, and it's coming down to the assumption that inflation is going to kind of come down lower, and it's going to be a result of the aggressive hiking regime that the Federal Reserve has put in place. So again, I find it interesting that these big calls aren't necessarily being made on the fundamentals of AI or investment coming from the IRA, for example. It's coming from the rate story.
But I feel like, Kriti, it's because everyone got married to this recession narrative. They just kicked down the can, kick the can down the road, saying, okay, we didn't get a recession this time, we're just going to get it later. I feel like that's why they're not citing the fundamentals, Kriti, because they refuse to believe that we won't get a recession. So they just got to say, all right, maybe it's just multiple expansion that gets us there. I mean, we'll see. It does feel like this short squeeze in terms of strategists. All right, coming up, we're going to be speaking to Michael Reinking of NYSE next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China rallies. Beijing signals fresh support for the struggling economy, including further easing of policy curbs in the property sector. And investors gear up for earnings from some of the world's biggest corporations. So far, a mixed bag of results in Europe, and later today, big tech takes the spotlight. Microsoft and Alphabet reporting after the bell. And Russia attacks a port on the Danube River in Ukraine, intensifying efforts to cripple a vital export route for Ukrainian grain to reach the world's markets. I'm Kriti Gupta in New York with Dani Burger in London. Dani, a lot to digest here, but it feels like this China story really taking the spotlight ahead of earnings and central banking.
It totally is. The narrative, at least here in Europe, that seems to be playing out is China exuberance and Europe concern. It's two opposite ends of the spectrum of how we're trading. On the China end, it was the communique from the Politburo erasing that sentence that says that the housing market is not for speculation. We had property buyers in China rallying some 10%. A lot of the commods rallying. Kriti, I know you're going to get that covered, but the way it translates into the European session was all these basic resource companies up more than 3.5%, by far the best performing sector, which means overall the benchmark is able to eke out some gains. Now, for the Europe sour, the doom and gloom here in this country has to do not just with yesterday's PMIs, but we had the ECB lending survey today. Kriti, you and I already talked about this, that we're having lending slowing, corporate demand by the most on record. It's even less than 2008. So the euro was gaining this morning, undoes that. It's now weaker versus the dollar. And two-year yields, they initially reacted in Germany. We did have some buying, but that is back into selling, Kriti. So those yields are higher by about 2 basis points.
Yeah, a lot to digest, and I'd say some of that sentiment kind of spilling over into the U.S. session as well. When you look at what's moving stateside, futures are still higher to the tune about 0.1%, 45.88 on those contracts. Look, no major conviction, but still a little bit of optimism, again, coming from abroad. The bond market is where it gets really interesting because look at the front end of the curve. 486 already move about 5 basis points lower. We are only about 30 minutes into the pre-market session here in the U.S. The 10-year yield going in the opposite direction, 389, higher by about 2 basis points there. Brent crude, though, is actually lower, which is interesting to me, Dani, because it's down by about 0.1%, trading about $82 a handle, whereas copper is rallying. And again, that comes down to the China story. How does that translate to the U.S. story? Joining us now to break that all down, Michael Reinking, Senior Market Strategist at the New York Stock Exchange, joins me right here on set, bright and early. Welcome.
Hi. Thanks for having me, Kriti. It's great to be here.
Always. Let's talk a little bit about this China story before we get into the nitty-gritty of the rest. You know, we have earnings, we have central banking here. Why do we see the sensitivity to what's going on in China when you're starting to see the economic outlooks of all three regions kind of diverging even further?
Yeah, so I mean, I think what we've seen, from China is that they're really committed to try to, kind of re-spur growth. Markets up until this point, have been pretty unimpressed by the, by the measures that they've taken at this point. But it does seem like, you kind of the cumulative effects of all of that put together, I think will ultimately help that economy, kind of come back. We're not seeing kind of that shock and awe sort of campaign that we saw, kind of post the financial crisis in 2008 and 9. So we haven't seen, the commodity markets, react in such a similar fashion. Just the kind of the debt overhang, that's within that country, I think is still kind of slowing the growth outlook there.
Well, it's interesting you say slowing the growth outlook, because that was kind of the consensus. Dani and I just spoke about this. The consensus that everyone was saying a recession is coming, no doubt about it. And here we are seeing a lot of folks from an economic point of view and even an earnings point of view saying, actually, things are looking way better than we thought. And that recession we're talking about might be years away instead of quarters away. How do you square something like that when you look at the growth behind the earnings picture this week?
Yeah, so my thoughts, in terms of kind of some of those recession calls, I thought they were pretty early. If you kind of looked back historically at some of the tightening cycles, right, you don't really start to see the lagged effects of monetary policy really kick in until kind of 12 to 18 months, right? So we're starting to get into that kind of time period where you'd start to expect to see, some slowing. I do think that there's been some less interest rate sensitivity in the economy this time around, which is also why I don't think we've seen, such an impact on, kind of on the U.S. economy. If you think about, 2007 and 2008, there was much more reliance on kind of ARM mortgages, right, where everybody's locked into fixed rate mortgages after a decade of, very low interest rates. And you've seen, kind of the corporates during the, kind of during the last couple of years have really extended out their maturity profiles, right? So we're not seeing kind of that immediate impact from kind of the rate increases. In terms of earnings, the earnings have been much more resilient than the street has expected, right? We've seen the cost-cutting measures that have been put in place over the last few quarters have really started to bear fruit. And the numbers that we've seen thus far, it seems like the bar has been kind of lowered enough, right? The cumulative cuts that we've seen, over the last year. The real question, and I think what we've seen this earnings season is more a question about the positioning in specific sectors, right, and the stock reactions that we're seeing on the back end, as opposed to kind of the numbers being, being bad, necessarily, or good.
Yeah. I mean, Bank of America did say that traders aren't rewarding earnings beats this season as much as they usually do. Michael, is that because the expectations have been lowered so much, or is there something else at play here?
Right, so I think that once again, it goes back to that positioning and kind of sentiment. So if you think about the financial numbers, right, the financial numbers were pretty good, and as you kind of look, you look through them, but there are still kind of headwinds for that sector. We're seeing kind of net interest margins, continuing to compress, but that's not an area of the market, where that sentiment or positioning had gotten stretched. And you've seen a very, you've seen those stocks rally pretty significantly on the back end of numbers. And then if you look at something like, the Tesla or Netflix, kind of those mega cap tech stocks, which have had really big gains this year, I would say that last week's numbers weren't necessarily that bad, yet the stocks were off, 10% in that kind of 2-day period. Interestingly enough, two other areas of the market that have had significant rallies this year, the home builders and airlines, we've seen pretty strong numbers coming out of both of those sectors. And while those stocks had a hard time holding the gains initially, where they had kind of gapped up and sold off, there really hasn't, there hasn't been a desire to really push those stocks lower. And if you look at kind of the reaction in the days following earnings, right, those stocks have kind of come back and have actually held up pretty well.
Well, Michael, I mean, look, we have the individual earnings. I should say there's about $15 trillion worth of market cap reporting in just the U.S. alone. I mean, you said this in your notes to us. It's one of the most, if not the most important week of the summer, because we also get 3 central bank decisions. I mean, how do you want to be positioning like that? Should I look at this week and say, all right, I'm taking all my money out and putting it under my mattress?
Well, no, I mean, I don't think that's ever necessarily the right way to go. Look, I think from a seasonal perspective, we're kind of coming out of, if you look at the presidential, that 4-year presidential cycle, we're coming out of the best 3 quarters from a market perspective, and, kind of following midterm elections. And that was, partially why we were a little bit more positive coming into this year. But as we move into Q3, right, some of those seasonal, tailwinds, kind of start to turn into a headwind. And if you look out to kind of August, September, right, from a market perspective, those tend to be, kind of pretty tough months, right? So given the rally that we've seen, kind of how extended things have gotten, I do think that we could see kind of a period of consolidation here. I don't think that's necessarily a bad thing. I think it would be pretty healthy, but that's going to, I think that comes in the way of, some rotation within the market, right? If you could see some of those mega cap tech stocks, kind of trade sideways, hold on to some of these gains, and continue to see kind of the more cyclical sectors like energy, financials, continue to really outperform. That can kind of hold the market up, and I think that's that would be healthy action beneath the surface.
All right, Michael, a final question for you. I'm going to put you on the spot. Got about 30, 45 seconds here. When you're talking about positioning, and you've mentioned this a few times here, look, you get a front row seat. You're at the NYSE. Talk to us a little bit about the hedging. Talk to us about the volume you're seeing on the tape. In terms of kind of the market plumbing that I think a lot of folks were worried about, what are you seeing ahead of this earnings cycle?
Yeah, so I mean, I think, once again, we've seen quite a bit of positioning. Options markets are used very heavily, as you're in kind of earnings season, right? And you're seeing those options markets price in pretty extreme moves relative to what we've seen, historically during during earnings season, right? So I think people have taken a cautious view, up until this point, and so I'd expect to see some choppy action from here.
So a little bit of caution in the options market, but green on the screen in the
Yes.
lead up to it. Michael Reinking of the New York Stock Exchange walking us through all of the things we need to be watching this week. Thank you as always. Coming up, tech earnings in full swing with Alphabet, Microsoft, and Snap. All on deck today. We're going to take a deep look at what to expect next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. It's a big week for tech earnings with Microsoft, Alphabet, and Snap all reporting today after the bell. Joining us now is Bloomberg Intelligence global technology analyst Mandeep Singh and Bloomberg Opinion tech columnist Tim Colpin waking up early for us. Thank you both for joining us this morning. Mandeep, I want to start with you here because I think when people think of tech stocks or think of tech earnings, the immediate thought is that this is a defensive trade. But then you also have a lot of these corporate sales, like Microsoft Azure, for example, extremely exposed to the kind of cyclical business investment. Talk to us about kind of the macroeconomics that plays into some of these big tech earnings.
Yeah, I think in the case of Microsoft and Alphabet, clearly expectations have varied. In the case of Microsoft, it's expected to post, double-digit earnings growth on the back of this AI wave that it's riding. And in Alphabet's case, they're somewhat muted in the sense that they are supposed to be hurt by, ChatGPT, and just the search volume seems to be muted. And overall, I think when you look at the big tech picture, it's pretty obvious that, AI is the big driver, and companies that have a larger exposure. And I do think internet companies such as Meta and Alphabet are positively exposed. It's just the market right now is rewarding the companies more on the compute side and the cloud side that are exposed to AI.
Well, Tim, to that point, we talked about this when the earnings broke. TSMC, AI couldn't save it. So, Tim, are you expecting that for the other chip makers that are due to report? Basically, don't hang your hat on AI saving the day.
Yeah, I think Mandeep's right. I mean, those in the compute side are, in theory, doing better out of AI right now in this kind of early AI cycle. You have to build the computers, the AI computing systems before companies like Meta, Alphabet, and so forth can deploy them. TSMC, in theory, was going to be one of those. And to be clear, they are benefiting from AI, but the problem is that the bigger macro problems they're facing are outweighing that. So, for example, smartphones are still in a slump. Smartphones have traditionally been a major driver of semiconductors for the last decade. PCs also in a slump, really not doing very well for the last year or two. So those two things together is just much more of a problem for companies like TSMC. Than the upside they're getting from AI. And if we look ahead this week to companies like Intel, Intel's really not much of a player in AI. They're more in the compute side, so servers and PCs and so forth. So there's not a lot for people to hope for with Intel in terms of what they might get from AI. But because of that low expectations, there's upside, ironically, because we don't expect a lot from Intel on the AI side, but they do have some new products coming out in the second half of the year, which might be an upside for them.
Hey, Mandeep, is that fair for most of the tech companies? Generally, as an earnings statement, we're just talking to our last guest from the NYSE that expectations are low. For the tech sector, are expectations low? We saw maybe with Netflix, it wasn't low enough.
No, and you're right. I think when you look at the multiples, I mean, Microsoft is trading at 30 times 24 EPS. So clearly, valuation do look stretched. And even though it had a positive momentum coming into this earnings in terms of revisions, I would argue, I think expectations may be low for some of the ad names, especially Alphabet and Snap. The smaller ones clearly have muted expectations, but when it comes to the large cap, I mean, even Alphabet and Meta are trading at 20 times PE, so they're not cheap from a valuation perspective anymore.
Tim, one of the kind of obsessions I've had for the last couple of weeks, and Dani can really attest to this, is the antitrust story, the regulatory story. We've really been watching it closely. She's sick of it. I'm not. We've been watching it closely with Microsoft and Activision, of course, but this is a truly global dynamic. You're seeing a lot of the kind of tech crackdown in China as well. I'm curious about the exposure to China specifically and Asia broadly. How much of that is a risk or a headwind for some of these tech companies? What do you think, Tim?
I think any company out there that has any exposure to China, whether it's to procure from China or selling into China, needs to ensure that they've got a very clear China strategy in terms of how do they exit? Do they have enough people on the ground to understand and read the tea leaves? It's not just out of Beijing; it's out of Washington too, and more out of Brussels and Tokyo and all sorts of other places. So your government affairs people are probably just as important as anybody else in this situation, because there is so many moving parts in terms of what it all means for how you do business in China. The longer term, though, I think there's a reality that needs to be faced, if CEOs and chairs of the board have not already faced it, is that if you are inside the borders of China, you'll keep doing business inside China. But if you are a global company such as American or Japanese or European or so forth, the days of you getting a lot of revenue from China are probably numbered. That wall is getting built brick by brick, day by day. And so I think the exposure to China over time will have to drop. It's an inevitability, I think.
Yeah, it's really fascinating. Wait, by the way, can I just put something on the record here? Kriti, I'm not sick of you talking about antitrust, and I could literally never be. It's so fascinating, all the labor dispute. I just wanted to get that out there, Kriti.
She's clarified it for the record. Mandeep, I'm going to put that question to you, though, as well. If we're talking about this risk in China and Asia as well, to what extent is the market kind of shrugging off or perhaps not fully pricing in the antitrust risk that we are now seeing perhaps haunt Microsoft as our poster child, but others as well, Broadcom, VMware, Adobe, Figma, a lot of it which is coming from Europe, but potentially could be coming from the US soon?
Yeah, look, I think that's always been around, but these companies have found a way to, take stakes, what Microsoft has done with OpenAI, for example. And, Google has done the same with Anthropic. And that is their way to not get into this, whole aspect of whether they're buying a company and go through that antitrust scrutiny. I mean, Microsoft Activision, it looks like the chances are they're going to be able to close. So clearly, I think these companies are doing what they have to do in terms of building their capabilities, both organically and taking these stakes. But at the end of the day, I think when you look at Microsoft, for example, they are doing everything they can in terms of being that early leader in terms of positioning around AI. And they've done that successfully through a combination of these strategies.
Mandeep, when it comes to the advertising-based companies, Alphabet, Meta, we had S4 report earnings yesterday. The Martin Sorrell WPP ad agency, they were really ugly, and you specifically cited a tech pullback on advertising. Look, I know it's a much smaller company than those, but do you look at that and say, okay, this is a global trend? This isn't just a one-off for this specific company?
Yeah, I would say, I think overall, the data points that we have gotten around the SMB sentiment, for example, that has been positive. And these companies, especially Alphabet, Meta, they are overly indexed to SMB sentiment. And that's why these businesses are so good, because, they get a lot of the ad dollars from small businesses. If that sentiment is improving, you're going to see positive revisions, because that's what drives, the overall ad spend when it comes to the digital side of the equation. I think the ad agencies clearly are running against the trend that linear TV is declining, and that's where you cannot measure the engagement. But AI is a net positive when you think of, ad targeting for the digital ad companies. So that's why I don't think, SMB is what matters when it comes to seeing that upside in second half. And that was a good data point that we got last month.
Yeah, certainly a lot to digest. And of course, we're going to get a lot of developments, an alphabet soup, as you will. Dani insists on calling it. Mandeep Singh of Bloomberg Intelligence and Tim Colpin of Bloomberg Opinion walking us through what we need to know for this week. Thank you, as always. Coming up, a look at some of the pre-market movers ahead of that busy week of earnings reports. That's coming up next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Burger in London. Let's take a look at some of the stocks we're watching in pre-market trading stateside. Top of the list is Disney, perhaps delaying some of their 2023 movie releases. This really comes down to a labor story. Shares are down about 0.9% in the pre-market. We know that a lot of these Hollywood strikes are affecting the studios. Bob Iger himself, the CEO, Dani, had come out and said, look, this is the worst time possible for these strikes to happen. And now it's having a very real effect on their bottom line.
Yeah, I loved that because Fran Drescher, who's now head of the union and, of course, formerly of Nanny fame, said something where he was like, he's sounding like a medieval landlord or something wild like that. But it's almost turned into this strange class thing. But Kriti, I know you were also looking at some of the latest with the UPS strikes, too. What's going on there?
Yeah, I mean, at the core of it, it's labor across the country. Today, actually, you're expected to see UPS and the Teamsters Union come back to the negotiating table. That is a big deal when it comes to that contract, which is expected to expire this coming Monday, July 31st. So really staring down the clock on that. But of course, we are also watching those big tech earnings, Dani. The Google, Microsoft, Snap, all reporting. Microsoft specifically actually in the green right now, but they are expected to report some weak growth thanks to the cloud slowdown. But Dani, it does not reflect it in those pre-market shares. Green on the screen across all three companies in the pre-market.
It was really interesting talking with both Tim Colpin and Mandeep Singh from our tech team, saying that, look, expectations are very high for tech. It's unsurprising given the rally, but perhaps for these ad-based companies like Alphabet and Snap, I think we're kind of expecting a slowdown. It goes back to the macro picture. Are we really spending as much on advertising?
Yeah, and then you have to talk about the AI piece of the equation as well. Sure, it's fueled the rally a lot lately, but then you have to see how much of catch-up do a lot of these tech companies have to play. You're investing, sure, but is there that infrastructure? Do you have the chips? Do you have the consumer base? Do you have the data capacity to actually make that work and become as normal and part of our lives as, say, cloud is? That's going to be something I'm watching. In addition, some of the other pre-market moves this morning, 3M, GM, PacWest, all reporting before the opening bell, Dani. So a lot to digest and a lot of crucial interviews throughout Bloomberg Television and Bloomberg Radio. Surveillance is ahead. General Motors CFO is going to be joining them. Stick with us. This is Bloomberg.